must then close within 6 months. The perfect math expectation is 180 days from the sale date of the sold investment property. So if you've already got it identified, believe me, it's going to close. So now let's dig in a little bit, because I'm sure those rules make perfect sense to everybody. It's clear as mud, and it's going to be really simple for everybody to remember. There is no article that I have found on the internet, by the way, that completely answers every question on the 1031 exchange. So let's just kind of talk about the short list of the most common questions that your clients may have, because this is all I care about with this class. This is about me giving you enough understanding so that you can represent an exchange well. So a client can say, but I don't want to do this, but I don't want to do that. You can go, you're defeating one of the primary provisos. These rules must be followed. Anywhere in between there may be some gray area, but these are the 1031 rules that you've got to be able to hit in order to be able to clear those properly. And let me just rifle through those real quick. Again, both properties, the one that's selling and the ones that you're purchasing, must be titled in the same person's name. 2, the second investment property must replace the value of the first. 3, purchase property must replace the debt of the first. 4, must use all the proceeds in the purchase of the new property or properties. 5, must exchange for like-kind property or properties. If you're selling single-family dwellings, got to buy single-family dwellings. 6, must be identified in writing within 45 days what the new property will be. 7, you must close that within 180 days following. And then 8, you must not have access to the proceeds of the sale at all. The money must remain in that qualifier's account. This is where things consistently get confusing. People try to create a gray area of what is very simply black and white. One of the most confusing details that people deal with is what is the like-kind property rule. This is what states that the replacement property must be like-kind to the relinquished property, or similar to what you sold is what you got to buy. The IRS code identifies like-kind properties as any real estate within the United States. There's something I haven't told you yet. And it must be held for investment, trade, or business purposes. This is not a buying your primary home, selling it, buying your next primary home. That is a different practice in the United States and does not qualify under a 1031 exchange. So be very careful how that's being exploited. A like-kind property cannot be used as your principal residence or a vacation home that you're using for more than 14 days a year, right? You have to be careful about that too. But to make this as simple as possible, think of a like-kind property as what's the intended use from an investment mindset versus the intended use from a practical sense. Single-family home that is rented to produce income and appreciation is not similar in a practical sense as a farm is to producing income by selling crops. Like-kind. Can't say that enough. Can't get rid of a single-family rental property and go buy a farmhouse that is now going to be a farm crops property. Like-kind properties. That's probably the easiest way to put it, right? I could certainly send you a short list of what like-kind properties are, but there's a whole bunch of qualifiers out there that are on the market. The things that you cannot use the 1031 exchange for: a second home, can't do it. Timeshare, can't do it. Principal residence, you cannot use a 1031 exchange for your new principal residence. Can't do it. Home for a family member, cannot do it. And properties outside of the U.S., can't use the 1031 exchange rules for any of those. But anything else you want to do, go crazy. Short-term rentals, great. Long-term rentals, great. Speculative land, yeah, you could buy land, sell it, buy new land, use the 1031 exchange, go crazy. That's what it's all about. Apartment buildings, trailer parks, commercial buildings, land for growing crops. If you have land for crops and it made crop investment, and you've got potential to do the same in a bigger property or a similar property somewhere else, you can do that, not an issue. Office condos for commercial, also fully available, allowed to be completed that way. So the only other thing that you have to consider in all of this is how much does it cost? The cost for a typical 1031 exchange can be anywhere from about $500 to about $1,200. I actually don't find the paperwork to be that expensive. The main expense gets paid through that QI. They do the preparing and the recommended documentation and do all the holding of those proceeds for you. They'll take care of all of that through the completion of the exchange. We're going to repeat this a couple of times in here, so I want to make sure that we understand. Here's that, that other question keeps coming up. Well, I want to do this for my primary residence. What's the workaround? There's no workaround. 1031 exchange can be used to defer capital gains taxes on what they consider an investment property only. Principal residence, second homes, timeshares are not considered investment properties according to the IRS. So can't be done. What are the disadvantages to a 1031 exchange? That's probably just as important a factor. Deferring, and please understand that word, deferring taxation in the United States is probably just as important as paying the taxes themselves. If that money is being used to make you money, the government's going to be appreciative about it, and that's why they're allowing you to do this. But what could possibly be the disadvantages to a 1031 exchange? Additional paperwork, additional regulations, additional fees. That's not a great thing for everybody else. Oh, you mean it's going to cost me another $1,000 to do this? Well, versus the capital gains taxes, still might be the way to go. I got to identify another property within 45 days in a very difficult and a very tight market. Yes, you kind of need to know where you're going to go with this beforehand. That is one of the caveats. And I got to close it within 180 days. Yep, within 180 days, you've got to make sure that that is completed. The entire transaction must be done in that amount of time. It's got to replace the value of the relinquished property. Another thing that people may not want to do. Well, what if I'm just, I'm downsizing from one to another? Yeah, that's the wrong terminology. You can't use it that way. Replacing the debt load of the relinquished property. You got to do that too, right? The government is not looking for you to find a way to invest less money in the country. This is an opportunity for those investors that continue to improve their investment strategy, to grow their investment strategy, ultimately, so the government can make more money from it as well. They're giving you an opportunity not to get hit with the taxation every single time you grow the investment. You defer it until you're done being an investor. And then, of course, deterrent to some property buyers who just may not want to add complexity that's going to impact a normal transaction. I get it, right? But those are the only real disadvantages. If you have the capability of doing this, it's a great thing to do. I have clients right now that have multiple investment properties and a primary residence. Make sure that they know that they cannot flip between these things, and it's the kind of stuff that they need to have a best understanding of in advance. Do you ever have to pay taxes on a 1031 exchange? Yes, a 1031 exchange is a way to defer to another day in the future. Always advise your clients to speak to an accountant. A licensed CPA is important. This will allow them to discuss truly the benefits and the risks of a 1031 exchange. The rules can change and can be fine-tuned year over year when they release new tax codes. So don't think for 1 second, what I'm telling you today even works next year. It may not, but this is the way 1031s work today. How long must you hold a property after a 1031 exchange? To avoid tax penalty for not purchasing a like-kind investment, you've got to hold the property and use it for the same purpose for 2 years after the purchase date, which means, again, you relinquish one property, you purchase a new one. Upon purchasing the new one, if it was a single family investment home that you were using to rent, you got to rent it again, in the same capacity for 2 years. Don't try to snake them through this. And all of a sudden, oh, we're not going to rent our property anymore. We're going to turn this one into our primary resident after a year. No. They will find out. You will have other paperwork that you're going to put into play. Don't put your clients in that situation. This is not a workaround. It was a rental property that you replaced, must remain a rental property with the new purchase for 2 years after that before they can make another decision on how to work. And of course, they can continue using it as a rental property. There's no hit on that. How soon can you move into a property after a 1031 exchange, right? And here's something that we can expect. Certainly apropos for a client to buy an investment property and decide they want to move into it later, that's fine. But the IRS is very clear that any property that's purchased as an investment must never be used as a principal residence for a minimum of 2 years. After that 2-year period, fine, not a problem. Vacation rentals are the same. The exchanger may not use that property for personal use for more than 14 days in a year. They cannot use it for more than 14 days period over an entire calendar year. Additionally, it's advised that if the intention is going to be to move into that property and they're going to make it their primary residence after the 2-year period, then the property should be held for a minimum of probably 5 years before they sell it total. There's reasons for that. There's a lot of tax code to support it. Again, I am not an accountant and do not hold a CPA. So you want a CPA license, you want to make absolutely sure that you're talking to someone about how that does change. Mathematically, 5 years makes the most sense. Now let's talk about the people that are involved here. What does this qualified intermediary actually do for me? How are they earning the money that I'm paying for this? The QI is going to hold that exchange fund in a separate bank account specifically for the benefit of the exchanger until those funds are used to purchase the replacement property. The QI is also going to prepare all of the documentation for the 1031 exchange. The documentation does change and is subject to alteration, so make absolutely sure that they're using the latest and greatest forms. This will include the exchange agreement, assignments of purchase for the sales agreements, notices of assignment for both the buyer and the seller, the replacement property identification notice, and lastly, all accounting and tax forms will be done by the QI or whoever that entity is that you decide to be used, which is important. Let's review that. Who can actually be a QI? The IRS does not require a person to have a specific license or a certification to be a QI. It has to be a specific exclusion for any person who may have a conflict of interest with the parties in the exchange. So any person that's acted as an employee, an attorney, an accountant, an investment banker, investment broker, or real estate agent within the 2-year period preceding the date of the sale of that relinquished property is treated as an agent of the exchanger and is specifically disqualified from being a QI. It cannot be anyone that they have done business with in the last 2 years as an independent consultant or broker. Again, this is why utilizing the title company is important. They have these people, these third-party authorizations that can go through and take care of this for you.